While the FTX collapse marked some of crypto's darkest days, this could be the beginning of a potential meltdown for the entire industry. Now, Grayscale, the biggest asset manager in crypto, is at risk, putting the whole industry's future on the line. In today's video, you'll find out how Genesis Capital lost billions of dollars and why this could bring down Grayscale and the entire crypto industry with it. Welcome back to the Virtual Bacon channel, where we cover all things to help you build wealth in crypto. As of late, the crypto industry is all focusing on Digital Currency Group, or DCG, and how its potential collapse could make Grayscale the next victim. DCG is one of the biggest crypto institutions at the center of the FTX fallout, with many wondering if its collapse will be a death blow to the crypto space. Digital Currency Group is the largest crypto firm with some massive subsidiaries like Grayscale, Genesis Capital, and CoinDesk. It was once valued at $10 billion with over $50 billion in assets under management and led by everyone's favorite counter indicator, Barry Silbert. DCG rose to power as they were on the earlier side of crypto adoption. However, in the wake of FTX's collapse, one of DCG's subsidiaries, Genesis Global Capital, found itself in a massive hole, posing a threat to the whole Digital Currency Group empire. Genesis Capital is one of the many companies owned by DCG, but why does it have potential to bring down everything? Before you can understand why, you need to know the importance of Genesis to the entire crypto space. Prior to finding itself in a $1 billion hole, they were practically printing money as the leading crypto lending desk, providing yield services for almost the entire crypto space. However, things started to take a turn when Genesis lent $2.4 billion to the infamous now dead hedge fund Three Arrows Capital. Remember them? So back in May, before the Terra stablecoin UST depeg, Genesis traded $1.5 billion of assets with the Luna Foundation Guard, or LFG. As part of this trade, Genesis received $1.5 billion in UST and LFG received $1.5 billion in Bitcoin. As you likely already know, UST turbo nuked into vapor a few days later. If watching $1.5 billion get lit on fire wasn't painful enough, Genesis would experience a brutal few quarters, as trust in crypto lending was at an all-time low after the collapse of lenders like Celsius and uncertainty around Voyager and BlockFi. And it gets worse for them. The final blow for Genesis came in the wake of the FTX fallout. Shocker. Just like the Luna collapse, everyone was quick to say they had little to no exposure to FTX. And once again, we quickly found out those companies were lying to our faces. On the day of the FTX collapse, Genesis claimed to have no material net credit exposure. However, 2 days later, Genesis backtracked and announced that they had $175 million locked in their FTX trading account. Yikes. The pain doesn't stop there. 2 weeks after the FTX collapse, rumors started to swirl that DCG was looking to raise $1 billion. It clearly wasn't going so well because all reports suggested they had difficulty with the raise, cutting the target raise to $500 million after a weekend of meetings with investors. And yes, things get worse. Shortly after, it was reported that DCG had $2.8 billion in outstanding loans. Long story short, for DCG to survive, they need to raise the capital to save Genesis. If Genesis can reach a deal, they will have some repairs to do, but can potentially keep their doors open. However, from the outside looking in, not many are hopeful for this outcome, myself included. If creditors reject the deal, Genesis will likely go into bankruptcy with years of court battles, and DCG may have the same unfortunate fate. Regardless, their reputation will be destroyed if Genesis fails to recover. So while DCG would be saving itself temporarily by letting Genesis go under, they will eventually have to fight against creditors who believe that DCG could fully backstop Genesis. For the sake of DCG's own business, they really need Genesis to survive. The problem is, if DCG can't raise money to save them, where do they get the money? This is where DCG's other subsidiary, Grayscale, comes into play. To fill the massive hole that Genesis created, many believe that something is going to need to happen with Grayscale to cover the losses. Grayscale is DCG's cash cow, operating the largest institutional investment vehicle for all of crypto. Grayscale's largest product by far is GBTC, which is the ticker for its Bitcoin trust. GBTC is not like an ETF, so its price is unable to accurately track the price of Bitcoin Bitcoin. The main reason for this is GBTC shares cannot be redeemed for the underlying Bitcoin. The entire value is dependent on the credibility of Grayscale to maintain its business. As Genesis has been taking on more and more bad debt, hurting the credibility of Grayscale, people gradually speculate on the legitimacy of the GBTC trust. This has led to GBTC shares trading at a 45% discount compared to the value of Bitcoin held in the trust. This is a massive decrease for the shares that once traded at a 40% premium. Let's look at all of the things that could happen to Grayscale. First option for DCG is to sell its GBTC shares. During the Luna crash, biggest GBTC holders like Three Arrows Capital and BlockFi were forced to dump their GBTC holdings. The value of GBTC has already taken a beating. As a result of the massive wave of selling, DCG became by far the largest holder of shares, currently holding around $250 million in GBTC. If DCG had to sell all their shares, this would nuke the price of GBTC even further. This is bad news because many institutions and investors hold the GBTC, and if the price goes down further, this could deteriorate TradFi institutional trust to invest in crypto. Another option for DCG is to sell Grayscale itself. Grayscale is a cash cow earning hundreds of millions a year in management fees on their investment products. DCG could potentially sell Grayscale to a large TradFi player like Fidelity and let the rest of their business die, including Genesis, CoinDesk, and their VC firm. This would be both good and bad as institutional Bitcoin interest gets protected, but crypto-native firms will be massively hurt as the biggest lender, Genesis, goes under, taking DCG's reputation with it. DCG will also likely be selling Grayscale for pennies on the dollar. The last option that has most people scared is DCG winding Grayscale down. If Grayscale winds down, that would free up the 633,000 Bitcoins that are currently locked in the trust. This Bitcoin would then be sold to refund GBTC shareholders. Selling over 600,000 Bitcoins could not only dramatically affect Bitcoin's price, but more importantly, slow the speed of institutional crypto adoption. So where do we go from here? The potential collapse of Genesis is more than just about another failed company. It symbolizes an era of lending in the crypto space where shady companies were able to pump their bags using customer funds. While these shady players were able to get away with it during the hysteria of the bull market, these businesses showed they are not built to last, as they have now crumbled only a year after the 2021 bull cycle top. Whether it's FTX, Celsius, Genesis, or countless others, one thing they all had in common is they stayed greedy and were willing to betray their customers. Things like this happen in TradFi too, but the difference is they get bailouts. In crypto's free market, bad actors get flushed out. Unfortunately, this flush has not only led to everyone taking a hit on their portfolios, but potentially ruined crypto's best institutional investment products. Regardless of whether DCG, Genesis, or Grayscale survives, one thing is certain. This situation all but guarantees the end of the crypto lending era. So many crypto users have had to learn the painful lesson of not your keys, not your coins. If you haven't set up a cold storage wallet yet, check out the videos in the crypto security and safety linked in the description. Another lesson is that in order to earn interest, you have to take on some form of risk. The problem is, in this cycle, few people really understood just how risky lending their assets were and that they could lose it all. After all, there's no such thing as a free lunch. With some of the biggest exchanges failing, this shows why systems built on trust still come with a high chance of exploitation, and further solidifying why crypto's trustless systems are here to stay. If you're impacted by the actions of these greedy people, don't beat yourself down. Let's take our lessons, get wiser, and make sure it helps us make better decisions in the future. You can absolutely still build wealth in crypto. Bear cycles make millionaires, so stick with me, subscribe, and stay safe out there.